Hello there. Today is Wednesday, April 9th, and this is another special edition of the Kluge Wealth Advisor Group Client Connect video. Please note that we're going to be going to a weekly format for this video for the foreseeable future, just given the speed of events. Now in this video, we're going to discuss a number of things. The first is that we're going to touch on the three decisions that countries have and where they seem to have fallen in this point. We're going to talk about some historical context for what we're seeing here today. And thirdly, we're going to discuss a number of frequently asked questions. So let's get right into it. In our last video, we talked about how countries have three basic ways of responding to the Trump administration's tariff announcement. They can do nothing, they can retaliate, or they can negotiate. Now, at this point, it looks like most countries are falling into the negotiation bucket. I have no way of verifying this, but U.S. Treasury Secretary Scott Bessent claims that there's approximately 70 countries that have reached out to start negotiations. And I think very importantly, key U.S. trading partners like the European Union, Japan, and South Korea have all come to the table. And that would be in addition to Canada and Mexico, which are already negotiating. So it seems that for the most part, most countries with the biggest relationships with the United States are taking a negotiation stance. The exception is China, which is taking a confrontation stance or a retaliation stance. They have retaliated on U.S. tariffs by adding their own tariffs, and the U.S. of course has responded by upping the ante and adding additional tariffs onto China. Now, this in the short term is not good, and it is going to be a potential source of some very negative headlines in the short term. However, in the long term, there's a fundamental truth that exists, and that is that the Chinese need a large economy to sell goods to. And that large consumer economy only exists in the United States, and the Americans need goods. So there's going to be some sort of arrangements made. The question is the shape and the timing and how painful it is to get there. But I believe fundamentally the incentive structure, whether that is such that we do have to see an arrangement get made. Now, I also want to take a moment and just place some of the recent events in some historical context. As I was preparing for this video, I was thinking back about all the times where we've seen sort of these sudden market drawdowns and how, when we've got to this level of uncertainty and this level of fear that we're seeing. Now, I'm of course not making a comment on any individual client. There's a number of you, which I really have to take my hat off to, that have reached out to us to make sure that we're getting, adding money to accounts and getting money to work to, buy the dip. Which is my fundamental advice. We'll touch a little bit more on that later. But again, in general, investors are quite fearful, they're quite uncertain, and we've seen a very, very big drawdown in markets. As I think about this, I start thinking about all the other times where we've seen this type of uncertainty. And I think about the great financial crisis where effectively the fundamental underpinning of the entire world economy was going to be destroyed. Again, U.S. banks, the U.S. currency system is the fundamental basis of the world economy, and those banks were going bankrupt. The current events are serious, but they're not like that. There's also the 2011 European sovereign debt crisis, where you had countries like Italy, Spain, and Greece on the verge of bankruptcy. Again, the current situation is serious, but as I think through the potential ramifications of countries financially immolating, again, this is serious, but it's not at that level. We can again think through COVID, where we shut the economy down completely, as opposed to potentially having a recession. We just shut the economy down for a number of weeks. And there's also been other hiccups over time that have, that we've seen. And as I reflect on that, I know that there are clients, here watching this video that have been with me and have given me their trust and confidence since the great financial crisis. And through all that, we've always come out of this wealthier. And so this is why I wanted to convey my my core strategy at this point is that the smart thing to do is to make sure that we are buying into this weakness. We're using other investors' fear for our benefit. Now, we had because we rebalanced accounts in January, and because there was an excess of optimism at that time, we did raise a little bit of cash for some sort of an opportunity. Now, here's an opportunity to put it to work. And we've been doing just that. So we want to continue on that path, because the bottom line, and this is sort of getting into a frequently asked question that I got frequently here, is the bottom line is that from this level of uncertainty, forward market returns are extremely high. Now, pattern is not prediction, and I'm not making a prediction here. But if we take a look at the last time, uncertainty was this high, which was during COVID, the S&P 500 fell about 30% in the month of March, and then proceeded to finish the year 30% higher. So if you had $100 in the market, it went from 100 to 70 by the end of March, and then from 70 to 130 by the end of the year. When markets price something in and begin to look forward, the rally off that low can be extremely powerful. And there has not been a case in history that in modern history where markets have dropped and then stayed down for years before recovering. It could be weeks, it could be a couple of months, but it's not a situation where 3 years from now we'll just be kind of poking our heads above water, right? If we're in a situation like COVID where we just shut the economy down, period, and you saw a drop and then a unbelievably powerful rebound, this situation is arguably, although serious, not that serious. And we have to remember that these rebounds can happen. And this is, I think, especially true in this situation because the off-ramps are just so obvious, right? Somebody makes a deal. Donald Trump changes his mind, et cetera, et cetera, et cetera. There's lots of off-ramps. And once market participants realize that the sky's not falling and that, that we will work through this, then they will start to price that recovery in, and it will move as historically things have moved very, very quickly, and I don't expect different this time. So why don't we use this moment just to transition over to one of the most frequently asked questions we did get, because I just covered off one previously there, and that's just around recession and will this tariff announcement cause recession, and what are the outcomes there? So the bottom line is that if this Liberation Day tariff announcement is policy and not a negotiating position, as I previously stated, as advertised, this is pretty recessionary. It's very negative. It will impose major costs on U.S. consumers and producers and the whole chain. And that is very likely, that plus the uncertainty and the freeze of the decision-making process is likely to cause a recession, at least in my view. Now, that said, we're not at this. We're in a situation where, again, it continues to appear increasingly likely that the Liberation Day announcement was a negotiating invitation, and we've seen major U.S. trade partners come to the table. So I think the more people come to the table, the more trade partners come to the table, and the more deals that get reached faster reduces the chance of there being a recession. And this is not to say there won't be a growth slowdown, but a moving GDP growth from 3 to 2 is a lot different from going 3 to negative something. So we want to keep that in mind, and given the fact that we are seeing negotiations and countries are responding very, very quickly, that is a very, very positive sign. The other thing we have to think about too is that these tariffs don't exist in a vacuum, right? It's not like it's a negative. It's not only a subtraction. There are also other things in the system and the ecosystem of the economy that can provide offsets. So we use an example here, again, going back to the strange coincidence between the OPEC production increase announcement last week and the tariff announcement last week. We have seen the price of oil drop very, very quickly from the 70s into the 50s. We've seen a commensurate decrease in the price of wholesale gasoline in the United States. Now, as I'm speaking today on Wednesday, April 9th, wholesale gasoline in the United States is below $2 a gallon. Based on some research I've seen from a couple of days ago, which was using higher wholesale gasoline prices, there was an estimate that the change in gasoline price alone is worth $150 billion to the U.S. consumer. Now, is that a full offset? No, but I'm also only picking on gasoline here just to point out that you're not seeing these tariffs don't exist in a vacuum. The other thing we want to point out here as well is that if there is again according to our very own Dr. James Thorne here at Wellington, there is a 72% correlation between US CPI inflation and gas. And if gasoline prices drop, that would also drag inflation down. If inflation drops, that then leads to central bank rate cuts, which are stimulative. So we have to look at the full picture and remember that just because something bad happens, which could be a imposition of tariffs, it doesn't mean that there aren't other offsets in the system and that other things aren't going to happen to help get us out. So irrespective of that, again, the recession is definitely a risk. I don't think it's quite a base case yet, but it's something we're keeping an eye on very, very closely. And we want to make sure that we're also keeping in mind that there are offsets in the system that pull you out of recession. And if the economy is going to come out of recession, the market will respond on the upside, as it always has. Now, there's of course other questions out there. There may be other things that you wish to discuss. So I would encourage everyone viewing here that if you have other things you'd like to discuss, you want to discuss things that are specific to your personal situation, please pick up the phone, give us a call, book a time on Calendly, email us. We think we have a telegraph wire here still, and I do know Morse code from the Boy Scouts, so please reach out. And once again, thank you very much for your trust and confidence, and we'll look forward to speaking with each and every one of you soon.